Good morning, ladies and gentlemen. Absolutely nothing to be learned from the risk dial. It's still in very strong positive territory, but all that means to me is that the risk spreads are not moving. They're still showing that we are in risk on. But what is moving is the inter-asset spreads, and we will have a look at those later. I would disregard the high score. I think we're probably in a period of consolidation at best, and I will explain my thinking through the bonds, really. I think they are stuck, but they are rich. I have tried to emulate here the Fed stop plots with a cut in September, then one in December, so that's the two in 2024, and then a further four in 2025. I think this is just about the best that you can hope for. And even there, as you can see, the sofas at the front are rich by about 20 basis points or just below. It doesn't really matter how you space these cuts. This curve is rich. What the market is hoping for and is, I don't know, speculating that we will get is some kind of unemployment event, because we are unlikely to get an inflation event. We'll see through DBC, which is really stuck in a very tight range and has been all year, that we are unlikely to get an inflation acceleration. What the market is hoping, therefore, is an unemployment event. And I don't know whether we get it or not. No one knows. But even if we were to get one, we are rich. There's very little likelihood that the Fed can cut to a terminal rate which is much lower than 3.5 to 4% area, unless unemployment really does go for a Burton, as we say in England, and that means it goes substantially higher. I think the odds at the moment are pretty low, and therefore, while we see this kind of picture where the short end SOFR out to 2025 are 20 basis point rich, there's very little to hope for. And consequently, the bond market did very, very little last week. That makes sense. We keep on getting the auctions. Next week we have 2s, 5s and 7s, and then at month end we have the new QRA, which they've already said that they are going to not change the level of issuance or the percentages that they issue along the yield curve. And therefore we have very little to look forward to but a continuation of the same issuance, which is gigantic. And we already know that we are at the bottom of the distribution probability curve to where the price can go at the short end. And this 442 seems to be absolutely the bottom that we can hope for. Therefore, my prediction for the next, I don't know, several weeks is that we trade between 442 and possibly here around 469, 468, 470. We might not get to 470, but just short. But I would have thought for the next couple of weeks that is what we're going to do and work off those 20 basis points that these so far are rich. The twos need to go back a lot less than 20 basis points because they can anticipate other things. Threes, I would have thought that we retest this 437 to 442 area, and the fives much the same. I think that eventually we see 427 again, and that is about as bad as it gets. What I don't like is the 10s and 30s. I think the likelihood of them breaking higher is much higher than the likelihood of the short end, simply because of issuance. I would have thought that 30s can easily maintain this shallow range, which is being basically whatever the short end does, they're between 440 and 460. Now, what does that say about the yield curve? It says that at the moment it's going to be pinned. So here we have the 2s, 10s, and I would have thought that you can see last week it did absolutely nothing. I was going to get out just 1 basis point below. I was going to get out at 421, never got that. I mean, I'm short bonds anyway, so I'm not that bothered. But I would have thought that it trades in this 432 to 425 range for quite some time and just goes sideways, building up energy to eventually break it to the downside when unemployment figures allow. I don't think that's going to be in the short term. I don't think that that is going to be something which is imminent. I think we're more likely to be disappointed by how long it takes than surprised by how soon it arrives. And here we have the 530s. I would have thought that a period of trading between, I don't know, minus 20 and minus 29 is the best that we can hope for. Again, building up the energy to break these lows eventually, but I would have thought that that will be after the summer break. The ECB last week very clearly said, we don't know, we are data dependent, we're doing nothing, we're gathering more data. And the resulting effect on the Schatz has been absolutely nothing. It's going sideways and not much else that can be said about it. I would have thought that the likelihood of us breaking the 468 and therefore looking for further cuts than the ones that are already priced in is very low. A period between 268 and 292, 90 is just about as good as we can hope for. Bobble, much the same. I would have thought around 252, and the Bund, this 252 to 257 area is basically all I'm looking for to re-establish longs. I'm not short these markets, but I just don't see any value in them. I think it's a very narrow range that can continue for several weeks. The differentials between the two, therefore the US and Germany, are unlikely to change very much, but what is developing are the odds that eventually it breaks lower. Why would it break lower? Well, it would break lower because at some stage unemployment in the US rises and therefore the Fed starts cutting more than the ECB. That is a definite possibility. But this technical picture tells me that every time the 2s go up to 180, you're supposed to sell them. Every time that the 5s go up to this kind of level, 182, you're supposed to sell them. And every time the 10s go up to around the 182 to 184 area, you're supposed to sell them. And then, your stops become evident, closes above 192. I was quite prudent not to read too much into this break. I wanted confirmation of another week before I started really getting short of dollars, because when this starts breaking down and moving towards 152, the US dollar will go down 3-4%. It's not going to happen yet, but this is the technical picture. Eventually we're going to break this down, and we're going to break it down via bonds going rather than anything else. At the moment we're rich. The data says that bonds have got nowhere to go down in yield. In fact, they're more likely to go up in yield. And therefore, I think that we probably start going towards this 182 area. And I've showed you the 2s, I've showed you the 5s. But eventually, I think this picture says that we will start breaking down and that we will be trading around this kind of area come, I don't know, December, come the end of the year. That implies that at some stage unemployment does start going up in the US, but it's certainly not going to be in the next couple of weeks, And there's no point in speculating about what is going to happen further along than that. You just got to get in at good risk reward points, and this 182 area seems to be a very good risk reward point. One thing that I find interesting is that the spreads in Europe have basically returned to where they were. This is Italy against Germany. Before the French elections, this is where we were, and we've returned there. Now, the one that hasn't returned is Germany against France, and the levels that I've marked are absolutely correct. For us to get any kind of impulsion, we need to break this 62 to the upside, and then we're not going to go very far. We're just going to go up to this level. What this tells me is that the risk in French bonds is actually much greater than the risk in Italian or German bonds. It's, you know, I got long looking for this kind of move in the spread. I got it against gilts. In fact, it didn't move that much against gilts. I should have stuck with Germany. But to me, this is a spread which is on borrowed time. It might move a few weeks sideways, but unless it starts breaking above this minus 62.5, the market is telling you there's real danger in France. So keep an eye out for that. Nothing that we can do at the moment, but the market is telling you that they're uneasy about France. The fact that they got the Italian bonds right back to where they were and they're not taking the French bonds back, that tells you they're very weary of the current situation. For those of you in the UK, this is the butterfly with two UK gilts in the middle and the US and Germany on the wings. All I can say is that if it starts busting through this 165 area, it's going to go a lot higher. I mean, this is the period where gilts had a nightmare, and I think that it will break higher. And that is why I keep on saying that Labour governments and crises go hand in hand. At some stage, we start turning this 200-day moving average and we start breaking this 165 area. And when it does, I think we are going for a minimum of, what's that, 75, 70 basis points, something like that. I think that that is likely to happen, but it's likely to happen much closer or even after the budget in the UK. But in the meantime, this is just telling you that the market doesn't trust the gilts at all. And it will pay to look at this spread from now on a weekly basis. As the 10s US Germany couldn't stay below 172, the dollar rallied back. DXY is likely to top out at this kind of range, 104.80, and that's when I want to double up my bets, 104.80, 104.90, and then start going down in line with what I said is likely to happen with the spread. It's likely to go up towards 182 and then, start looking to break down. To me, that indicates in Euro USD what? We're coming back down towards 108, and then we're going back and testing this moving average around the 110.65 area. So a little bit of downside and then a break higher. I want to double up at this kind of area, 108 the figure, or just above 108 the figure. And as I just showed you in DXY, that is somewhere around the 104.80, 90 area, and I think I will be going in much heavier up there. As the title suggests, I think we're in a period of slight deleveraging. I mean, nothing huge. And I will examine that much more in the equities section and explain it much better. But when you deleverage, you basically sell all assets. You sell all assets, you raise cash, you bring down your multiples. Basically, you have less risk on your book. And then you sell, to achieve that, you sell basically everything you have and what you can sell rather than what you want to sell most. And that is likely what happened to gold on Friday. People just came in and hit it. It's a much thinner market than bonds. It's a much thinner market than equities. It's a much thinner market than anything. And this is the result, back down to 2400. I never understood what people wanted with it up here, why they thought it was a good idea to go long gold there. But what do I think now? I think that we are very much stuck, just like bonds are, in a period between 23, just above 2300, and just around the 2430 area. That should be the range for quite some time and allow these moving averages on the weeklies to catch up. I would have thought 4 or 5 bars, weekly bars, and maybe one of them breaking this level just to stop everyone out is what the doctor ordered. And then towards the end of the year, or the last quarter of the year, let's say, then we can start testing the upside again with the bonds. I don't think that gold is something that you should be owning right now, because it just doesn't make any sense that while bonds back up, while equities back up, while people deleverage, they are going to buy an asset yielding zero. They're much, much more likely to buy things like floating rate short notes yielding 540. They're much more likely to buy T-bills. Buying gold here for what? I just can't see any rationale. And here we have DBC. I mean, it's not exciting, is it? It's quite clearly in a range between 2175 and 2439, and it can't even make the tops of the ranges. It just keeps on failing. And if we have a look at what that is against oil, it's basically means that we are stuck in a 75-84 kind of range. And while that is happening, the odds of inflation reaccelerating in the US, or anywhere else for that matter, are very, very low. And that is why I don't think that the next excitement in bonds comes from CPI or PPI. And we have PCE at the end of this week, which we already know what it will be. It has to come from the performance of the real economy and therefore unemployment. And we really don't get any news about that until Thursday, when we get the weekly unemployment claims. But those are only going to change very, very slightly week by week, and it's not going to be enough of an impulsion. We really need to wait for a non-farm payroll or something like that at the beginning of next month to get any excitement to the upside in bonds, in bond prices. Until then, I think, as I showed you earlier, it's much of a muchness where we go. If I look at DBC or I look at oil and everything, it basically says that we are supported in this kind of area just above 2175, and that is likely to be a bounce area. Triangulating that with gold, it just basically means that this spread just goes sideways for the time being. It's summer, it's unlikely to make big breaks, so I would have thought that this kind of area around the 2220 area is going to be supported next week. But does that mean anything? No, it just means that we're going sideways, that bonds aren't going to have pressure from inflation on top, and that's all that can be said. These assets are not moving. So, what do I think happened last week? I think it's very, very simple and it's mostly technical. I've been saying for weeks, never ever buy the SPX at the top or through the top of the monthly Bollinger Bands. That is where we were. We just kept on hitting our head against that 57, 15, 20 area in ES, which is the top and just through the top of the weekly Bollinger Bands. It's just so obvious to me that there would be real cash sellers up there. People who say, I will rather go into cash, like me. I would rather hold cash at that level rather than hold equities and have risk. And I think the overhang of mega cap and every other kind of cap up there was large. And what happened as soon as the market started sniffing out that the Trump trade was on? What is the Trump trade? Well, lower regulation, and therefore energy stocks, secondary energy stocks, financials, i.e. secondary financials, and all that stuff is basically in IWM. It's in the Russell 2000. It's the crap that nobody wants and that every single hedge fund was short of against the mega caps. QQQs, the semiconductors, all the thing that has been flying for the past several months, i.e. from here, basically since, middle of March, while IWM has been doing nothing, like it should do, because it just contained 2,000 zombies that will never amount to anything. So that trade made sense, but they all got blown up. And let's have a look at what happened there. And this is a chart of the Qs against IWM. And this is basically what happened. The hedge funds got caught on that trade. And by definition, IWM is value, right? What people consider value in inverted commas. I considered it rubbish, but they consider it value. And when you own value, you don't really care about the price. That's why you buy value. You think it's cheap. So you're not going to sell it unless it goes a long way. And this is what happened. There are very few value sellers. For them to even remember they have this rubbish in their portfolio, it has to go a long way. Some little bell has to ring, and they say, ooh, it's no longer value. In fact, now it's expensive. But for that to happen, it needs to go a long way. And this is where we are. We've basically just gone back to the 200-day moving average in QQQ IWM. Do I think this is disaster? No. I think this is probably healthy. And if we have a look at XLE over QQQ, much the same kind of thing happened. And we'll probably go to somewhere around here and then we'll top out. I think XLE is probably a good hold at the moment. But over the long term, there is no one who is going to tell me that a bit of energy is going to beat the human innovation for long. I mean, look at that chart, okay? So this is, if you go back to 2008, 2009, it's a clear straight down run. Does that mean anything for the next 2 weeks? No, it can probably go easily up to 20. Because at the moment, people are going to be enamored with these Trump trade stocks, and especially if Biden now drops out of the race, I think we can easily go to this level. And that is what's going on. People are dumping the mega caps because they got caught out in this trade. Long mega caps short everything else. It no longer works, and that's what's going on. They're getting stopped out, and it takes a long time for them to turn over that portfolio because they have to find these rubbish stocks, and it takes a long time. But if you look at the totality, ITOT over government, does this say that equities are going to underperform bonds? Nope. This just basically says it's a small hiccup. We might go back down to here, but that's about it, and then we're in a range. Equities are still going to outperform bonds for a very, very long time indeed. Other people getting stopped out could be our opportunity. So this chart is XPM over XLF, and it's only here to show you that JPM is outperforming and continues to outperform the XLF components. And this chart is JPM over KRE, i.e. the regional banks and the other rubbish that nobody wants, because the growth is going to be zero there. So it's coming to a very interesting level, which is this 200-day moving average. And we've actually broken out of this range that we've been in since basically, I don't know, March. I don't think it goes much lower, okay? My bid is around here, 363 to 365. I think you should be looking to swap any KRE you have or put on a trade, short KRE, long JPM. Look how far it's come. It's come from 428 to 375. Work that out in percentage terms. And all because the IWM has outperformed as these people have been stopped out, as I've been just explaining to you. To me, that is an opportunity to own a quality stock like JPM and short rubbish like KRE. So this is my clean chart in the SPX, and let's enlarge the last few days. What has it done? Well, really not a lot. To me, until we start closing below 54.47, nothing much is going to happen here, and then we are 43.72 to 43.27. I can't see us before the Fed closing below this level, and even if we do an ABC, this is the kind of bottom area that you want to be buyer at. A very strong call spread. I don't think the Fed is going to cut and help that way. In fact, I don't think that a cut by the Fed in July is a help. I think it's a hindrance, because actually it steepens the yield curve and it makes people sell duration. So I'm not looking for the Fed to help the SPX. I'm just saying that SPX is going to basically, how shall I put it? It's going to consolidate and build for the next phase. Why? Because it just won't get cheap, I don't think. Why would you think that the SPX is going to get cheap? I just can't see it, not unless the economy starts giving up. And as I said, I don't think that for several weeks you're going to get any indication of that. So to me, this kind of area between 54.47 and 53.72 is going to be a very, very strong buy for 2, 3, 4% retracements to something like this area, 55.27. This is the kind of range that I think that we are in until the Fed. And the other market that I find interesting here is the European market, the stocks. We are back towards this 48.50 area, which I find key. And I am hoping and praying that we get a break out, as the S&Ps go towards that gap fill that I just showed you, potentially. I am hoping that we come and we trade this 0.382 retracement at 46.80. This area here, I will be a buyer of call spreads. I think that all they're going to do is stop out whoever has the stops below here. It goes a little bit lower and then it just moons. it's very, very unlikely to me that this is not going to be a very good buy, even if it's for a few days and a few percentage points. Write this down: 46.84 to 47.25. This is the kind of area that you want to be buying call spreads. As far as the QQQs and NDX is concerned, I've had this line here at 18,875 for a long time, and it's now matching with a 50% retracement of this move. I think technically this is the kind of area that you want to be buying: 18,875, some call spreads, because I think that, if you ask me where are we going to go in on Fed Day, I would say very much unchanged. But in the meantime, we have room to go down and stop everyone out and then return higher. We have 7 trading days till the Fed, and I think that's going to be your price action: down and up and nowhere at the end of the day. So this, on the QQQs, you're looking just below 460, around the 458 area. And on the NDX, you're looking for 18,875. And those become very good long risk reward levels. I've changed the levels where they needed to be changed. I am looking for these kind of levels to start getting long. 18,875, as I mentioned in the NDX, is the kind of level that I want to look at call spreads. But otherwise, I think it's going to be very boring in bonds. And I think that they are going to go at least another 2, 3, 4 basis points higher in yield. And therefore, we will most probably start testing these levels before the auctions and at the auctions. But by Thursday, we probably will have exhausted the bonds. And that is when I think that the equities can start coming back with the bonds. So first few days, maybe some more pressure on equities. And then by the end of the week, we are not very far away, I don't think, from where we closed this Friday. So that's the kind of price action that I expect for the reasons that I've explained to you. I think it's going to be a boring week, a very technical week, and precision is going to be key. Thank you very much indeed, and tweet you tomorrow.